The Federal Reserve has raised interest rates again amid uncertainty about future rate hikes. Markets have been closely monitoring the situation, speculating whether this hike could be the last for a while. Fed officials are keen to observe how the previous increases have affected economic conditions before making further decisions. During a news conference, Chairman Jerome Powell acknowledged that inflation has moderated somewhat since the previous year but emphasized that reaching the Fed's 2% target still has a long way to go. He indicated that they might potentially hold rates steady at the next meeting in September, depending on the data and economic indicators. The post-meeting statement didn't provide specific guidance on future moves, maintaining a data-dependent approach, which aligns with the stance of most central bank officials. The rate increase received unanimous approval from voting committee members. One notable change in the statement was an upgrade of economic growth to moderate from modest, despite expectations of a mild recession in the future. The statement also described inflation as elevated and job gains as robust. This latest rate hike marks the 11th time since March 2022 that the FOMC has raised rates in a tightening process. The June meeting was skipped to evaluate the impact of the previous hikes. Powell has expressed concern about inflation levels and hinted at the possibility of further restriction on monetary policy, indicating the likelihood of more rate increases. The Fed funds rate, which determines overnight lending rates between banks, affects various forms of consumer debt like mortgages, credit cards, auto loans, and personal loans. It's worth noting that the Fed's approach to rate hikes has been historically aggressive, resembling the early 1980s when they were battling high inflation and a sluggish economy. Recent news suggests that inflation is improving, with the Consumer Price Index rising at a lower rate than a year ago. Consumers are also expressing optimism about future prices, according to the University of Michigan Sentiment Survey. However, inflation rates, excluding food and energy, remain relatively high, and the Fed's preferred measure, the Personal Consumption Expenditures Price Index, is also above the 2% target. Employment also has held up remarkably well. Non-farm payrolls have expanded by nearly 1.7 million in 2023, and the unemployment rate in June was a relatively benign 3.6%, the same level as a year ago. Along with the rate hike, the committee indicated it will continue to cut the bond holdings on its balance sheet, which peaked at $9 trillion before the Fed began its quantitative tightening efforts.
Like, comment, share, and subscribe.